Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Wednesday, January 4th, and then we'll see how things look for Thursday, January 5th. We had an update, and it looks like things just might be improving a little bit. However, we're just at the top end of the range that we've been in for quite a while, so we're not really breaking out. But with the update, some of our indicators are starting to show a little bit more of a positive signal behind them, but we still have the majority of our indicators that are negative. So before I start, please be reminded that this coming Saturday on January 7th, there will be a free webinar that you can participate in. And all you have to do is provide your name and email address. There's no obligation. I'm not connected with this. I'll just be a fellow participant. But the attempt here is being made to look out into 2023 to see what kind of things we might be able to put together as far as what might happen. Here is a screenshot of the form that you actually fill out. Then you receive a confirmation email. And then not too long before the event starts, you'll get another confirmation. It's being conducted through Zoom, I believe. And so you'll be able to just click on that and participate in the event. So let's go back and talk about what happened. Right at the open, we had a gap higher. Again, a lot of the strength came from the futures before the market even opened. We were able to get above the daily pivot right off the bat at 38.32. Then some selling came in. This was very similar to what we saw in Tuesday's action. A gap higher, we went up, and then selling started. It wasn't as drastic in Wednesday's session, but it was kind of the same basic pattern. We then fell below the daily pivot, and we went all the way down to the unchanged level, which is a built-in this case, support level. When we're going up and we come down, a lot of times the unchanged level will provide support, and that's what happened on Wednesday. As the day went on, prices went back up. We got up to R1 at 38.70. Then we fell down some more, back down to the daily pivot, which we then retested that level twice. Prices rebounded from the daily pivot, and we ended up closing above 38.50 right into the close. We were up 0.75% on the day. Volume was actually back to above average. We haven't seen that in quite a while, other than an options expiration day. But it just shows that folks are starting to come back in now. The technicals, negative, with a few things looking a little more positive. And I have some charts to show you of that. But inflation and interest rates, that's what the market continues to be fixated on. We've been fixated on that for most of 2022 and now starting into 2023. So unless one of these other scenarios that we look at or some of these events, they come into the picture, it'll probably continue with what's the Fed going to do? Are interest rates going to go up? How about inflation? Is it going up or is it going down? Those are the things that we are just talking about and thinking about each day. Here's the intraday chart showing how we gapped up higher. And then we came right down below the daily pivot to the unchanged level. Yeah, we fell a little bit below that. But by the time this bar closed, and these are each 10-minute bars, we were right back up at the unchanged level. We bounced back above the daily pivot. We got all the way up to R1, which then provided resistance. Tried to hit that a couple of times. We're not able to get through that. So then we broke back down, came down to the daily pivot, a little bit below that even, before bouncing up and going down. And then right into the close, we saw some buying entering into the market, which really helped to give us a more positive day. Here's a 1-minute candlestick chart because we had the FOMC meeting minutes that were released. And a lot of the strength was seen before the announcement was made. And then this gyration where I'm circling with my pointer, this is when the meeting minutes came out, and there were some parts of that the market didn't really like, but we still bounced all around. We ended up going back down before bouncing up and then down. So it was one of those days where you had to take your Dramamine, that's for sure, because we were bouncing all over the place. Also be reminded that every day on the community tab in the YouTube channel, I update 2 charts. One that gives us the monthly pivot points that are good for the whole month. I just update that with the latest prices. And then every day, a new chart that I upload is the intraday chart, giving us the intraday pivot points for the next day. So what are some comments that we can make? We're out of this Santa Claus rally period now. And this is one thing that kind of bothers me, because we did have a slight gain. So when you put this down in the history books, it's going to suggest that we did have a Santa Claus rally. But my goodness, look at what we had to go through to get that slight gain. That's why I really struggle with these broad generalizations about the market's going to do this, the market's going to do that. Yeah, it was a Santa Claus rally because we finished higher than we were at the start of this period that we were looking at, but it just took everybody on a roller coaster ride through that. So that's why I just don't like these real blanket type sayings that people come up with. Also, be reminded that on January 8th, that'll be a Sunday. So the first day will be January 9th, how it impacts the US. China is lessening their quarantine requirements. This could help the supply chain. This could also help companies that buy a lot of products from China. And I don't know why in yesterday's video I said Japan, even though they're pretty close to each other. And this should help the Chinese economy and those businesses that actually do a lot of business in China. So that could have a positive impact. But my understanding that like 70% of Shanghai is sick, but it's the Omicron, which tends to not be the real bad version of the coronavirus that we had all the lockdowns about. So you have a lot of people that are sick, but it's not as bad as it was before as far as how sick people are getting. But there's a lot of people that are getting sick. Because remember, China was one of the first countries. I mean, they locked down completely. There was one student that I have where this all happened during their spring festival, which is their big holiday of the year. And they had some people come and visit them for the spring festival. And my student didn't really care for the people, or at least it's a cousin or something in her family. Well, while that family was visiting them, that's when all the lockdowns happened, and they had to stay for months while they were trying to figure out what was going on. And my poor student had to battle with this cousin that she doesn't really get along all that well with the whole time. And my heart just broke for her because it was a pretty difficult situation. The FOMC meeting minutes did come out, and the part that they kind of latched onto and a little bit why we darted lower was this one statement saying no participants, that means FOMC members, anticipated that it would be appropriate to begin reducing the federal funds rate target in 2023. The market's been kind of hoping that that would happen, that inflation has topped out. Maybe interest rates will stay at a certain point and then start to come down. Well, this kind of flies right in the face of that we're not really going to lower interest rates, at least as it looks for right now. Now, that could change. If the economic reports that we get show a lot more weakness, the Fed may have to change their stance on that. But based on these meeting minutes, the Fed is not ready to do that, even if the market desperately wants that to happen. We're still bumping up into the 20-period exponential moving average. That's one of the shorter term moving averages. We hit that in Tuesday's session. We hit that level pretty close in Wednesday's session. So if things are going to turn a little bit more positive, we want to break above that 20-period exponential moving average. The VIX is still acting strange. We're still seeing a spike on that one chart, and I'll show you that because of the concerns about the earnings per share and valuation. Just that maybe the market is too expensive when you compare it to what are the earnings looking like. The dollar did decline and interest rates were down. So the dollar declining kind of helped stocks a little bit, as did interest rates going down. So, and I mainly look at the 10-year yield for that to determine if interest rates are up or down, because that's pretty much the benchmark. But we pay attention to a lot of other maturities as well. In the short term, we still have a little bit of an oversold condition or extreme negative. with our PMO studies and our stochastics. In yesterday's video, we had I think it was I forget which one, but it's no longer extreme negative. And then I finally went back and changed these. All the yield curves that we have been watching, the 10 to the 5, the 10 to the 2, the 10 to the 3 month, the 10 to the 2 and the 10 to the 3 month, those are the ones that are probably the most important. And then the 30 to the 5, which it's that big a deal, they still remain inverted. Sentiment is still fearful. We're not getting extreme fearful, at least yet. The economic reports that came out, mortgage applications index, it came down 13.2%. So we're seeing continued weakness in the housing market. The ISM manufacturing, and this is probably the bigger report of the day, it came out at 48.4. They expected it to be at 48.5. So this was a little weaker than expected. The last time we had the report, it was at 49. So it's been declining. And anytime we're below 50, that's suggesting that the economy is contracting instead of expanding. The JOLTS job openings came out at 10,458,000, which was a little less than the 10,512,000. But over a period of time, we've been seeing this number decline. It was in the 13 millions, then the 12s, then the 11s. Now it's getting into the 10s. So it just shows that there could be some weakening in the employment situation. Our trend is negative, and we've dropped back below with the up day because the ADX was defaulting to the downtrend. So it fell below the moving average. So now the ADX is weakening and it's still below 20, suggesting that we're still in a sideways choppy move. And you can easily see that by looking at a chart, and I'll point that out. Our bias, I've switched back over to mixed. Even though we had the up day, we're just at the upper end of this range, and our momentum is still mixed as well. We're kind of at that tipping point where the market could go either way, but it is showing some improvement currently. This is a chart that I've been showing that will ultimately drive stock prices. The white line is what we really pay attention to, and this is showing how the earnings per share has been declining. It started in early summer, late spring, early summer when it topped out, and then has been going down. And that's a lot of the headwinds that we're seeing in the stock market. We're battling with the Fed right now, with them raising interest rates. And because they're raising interest rates to a large degree, that's why we're seeing the earnings per share really start to drop. And that's why the market, it's not your 2021 market anymore. We've gone into 2022 and now 2023, where the environment has shifted. So if you're implementing a lot of the same tactics that you did back then, you probably had a pretty difficult year. Where what I try to do is I have different tactics based on what the market is actually doing, then I can easily adapt to those different scenarios. This is a chart that I said I was going to show in yesterday's video, and then I forgot to put it on a slide. This is an Edward Yardeni chart, an economist that I do respect. And the red line here is the S&P 500, okay, and how we topped out in early 2022, and then we've been coming down and bouncing around. We have a downward slope here. Well, when you take all of the assets of the Fed, the European Central Bank, and the Bank of Japan, and plot it on top of what the S&P's been doing, and the scales over here on the right side, it has really been coming down. When this blue line tends to go up, that gives a lot of support to the stock market because the Fed is introducing money into the economy, or any of the central banks are doing that. And that gives support to bond prices, which pushes interest rates down. And it gives support to stock prices, which tend to go up. And we're seeing how this has been declining. And it's probably going to continue to decline, which could provide more headwinds for stock prices. This is another chart, and I totally butchered it when I was trying to say this. I'm on some new medication right now to help with this inner ear infection, and I'm just kind of, I don't know which one of the 7 dwarfs. I kind of go through all of them each day. But when I did the video yesterday, I think I was dopey. Other times I'm sleepy. Believe it or not, I'm sneezy and bashful, whatever. Okay, I teach little children, so I'm aware of who the 7 dwarfs are, and I have to talk about them sometimes. So this top line that I got from Isabel Net, this says if we're not in any recession and if we're around the 22 times earnings, or the PE ratio of 22, with the earnings per share at 205, that could support stocks back up to the 4,500 level. Then we drop down to this line. We're not in a recession, but we're dropping. So the earnings per share, or the earnings, ends up dropping at 17 times for the PE ratio, but we still have the $205 per share. If that continues to go, then we will probably drop down to this 3,500 level. Then if we have a soft landing, which it depends on who you talk to, but that's where you start to lower interest rates without hurting the economy at the same time. And I've never really seen one, but there's other people that I listen to their podcasts or I read their articles. They think back in, I think it was 1994, that we actually had a soft landing. This would be if prices continue to be at $205 per share, and that's taking the S&P as a whole, and we drop down to 15, that could get us to about the 3,100 level. And then if we really run into trouble, so this is why it's so important for us to try to figure out, are we in a recession or not? Because if we're in a recession, that's going to lower the earnings per share. And if they get down to 160 in a deep recession at 15 times earnings, that could take us down to about 2,400 at that point. So that's how important we need to know if a recession is happening or not. That's why we focus on this quite a bit. Another chart, it just says during periods of drawdowns, when you look at the next 12 months, this is looking forward. This is the forward PE. And the average is when we run into trouble, the PE ratio for the S&P 500 has an average of 14.2. Well, right now we're at 17.7. So that means that prices would need to fall to get more in line with the average valuation basis. Now, please remember, this is an average. There are times when we were higher than this, times when we were lower than this, but this just gives us some kind of a benchmark to look at. Then this is also showing how the M2 money supply, when it's going up, that gives support to the forward earnings per share races, earnings per share prices. Because when there's a lot more money out there, that means companies can spend more money and make more money, and this tends to help their earnings. Well, from 2022 into 2023, we're seeing a real contraction. You know, all the stimulus that the Fed did, the checks that were sent out, all the quantitative easing that was done to try to help get the economy going again during the lockdowns. Well, all of that's coming out now, and this is having a real impact on the forward-looking earnings per share. Then this is the S&P 500 hit ratio. When you have a lot of these AI programs or quants or people that use computer trading to figure out when to buy and sell in the market, and on any given day, 60 all the way up to 90% of all trading that happens is not even people doing it. It's computers that are doing it. And how did it work out when the computer thought, okay, projecting out into the future, I think the stock price is going to be higher than now? Well, you can see way over here on the right, they didn't do all that well. And there are times when these AI programs do really good, and other times when their algorithm really ends up leading to more losses. Here's the chart that I have been showing for quite a while now. The blue, why did I say blue? The yellow line is showing what prices did from 2006 through 2008. The white line is what the S&P is doing. If we follow what already happened in the past, we might see some more weakness. The VIX just hasn't really been behaving at all. I might end up taking this chart off because as we continue to go through the course of time, the pairing up of the model versus the VIX, they're starting to not go more hand in hand with each other. Here's another thing that's interesting. This is the VIX to the S&P 500 correlation. It's continuing to spike, and we're starting to get to an extreme reading. When this goes up and starts to come back down, That's when we're really going to pay attention to this, because if you look at the bottom where the red lines are, and I tried to adjust them recently, it suggests that we might have a short to intermediate term pullback in the S&P. The Ulster Index is coming down a little bit now with the up day that we had. The equity put call ratio is now back more under control, but we're still working off of this huge spike up here. This is the daily chart, where here's the 5-day chart. But again, one warning sign on this is, see how we're going sideways based on price? This really spiked up and is now coming down. We're not seeing any kind of a critical mass reading. When these have been really powerful before is when the market's just been screaming down, we spike up with this, it turns around and goes the other way. That's not happening right now. We're just chopping sideways with price. So we want to be aware of this, but we don't want to bank on this too much either. And here's just a longer term look at that same chart, how we just really spiked up and we're coming back down now. We're still at a higher level than what we've been in the recent past. So we want to keep an eye on this. The ADX, it's dropping down below the moving average. So that's a weakening trend. Even though selling is dropping off, according to this, buying has also been dropping off. And these lines are getting closer to each other. So that's why we're below 20. So this suggests that we, and not surprising, if you look at this sideways action, kind of started up here. We were chopping around sideways, then we made, boom, a little move down to another level where we've just been chopping sideways for quite a while. The double and exponential triple moving average, that's not really what I want to show you here. I want to show you the anchored moving average going back to the COVID low. This is still providing overhead resistance. We've hit this level a couple of times now, and we're bouncing back down. So if things are going to turn more positive, we're going to want this to go back up. And this is at about the 38.60 level. So that might be a price area that you look at, not just if we break through it on an intraday basis, but if we can close above 80.60, that would help this chart to show that we're getting past the resistance. One thing that I haven't shown either, some of our oscillators, they're showing some improvement. This is the PMO, the price momentum oscillator developed by Carl Swinland. Overall, we're still in a downtrend, but then there's two different subdivisions of this indicator, one based on price and one based on volume. Well, the one that's based on price, it hasn't crossed over positive yet, but it's starting to. The interesting one is the volume. It's just getting ready to cross and go back over positive. Sometimes these bottom two charts are leading indicators of what the PMO is going to do. So I wanted to include that in this video. The slope, it's really our only oscillator that's looking positive right now. It's one of our shorter term oscillators. So it's suggesting that we're looking better, but all of our other oscillators, although they're improving, have not switched over positive. The BPI ticked up just a little bit, but we're still below 50 right now. So that's negative since we're below 50. And we're just continuing to chop more sideways with price action. What I've been really focusing on lately is this toppy looking pattern when the S&P was hitting some kind of a high and then we were breaking down from that. Well, we might be starting to turn back up. So this is showing some improvement. The PMO studies that we look at, the only one that I'm focusing on now, right now, is the buy signals. And we're right at this 20 level, which is the line in the sand between extreme negative and not extreme negative. So this is showing some improvement also. The short-term stochastics and the short-term time frame, that's not extreme negative. We're coming out of giving us an extreme negative reading with the intermediate term, and we're still going sideways and kind of trying to improve here with the long-term, short-term stochastics. Daily chart shows how we're just dancing along this pivot level. We're still below the 50. We're still below the 200 as well. So nothing has really been decided. And then down on the bottom, you see where volume did spike up a little bit above the moving average. We're still hitting the underside of our moving average tree. The 20-period exponential moving average is what has been providing resistance currently. So if prices do look to improve, we want to break through these moving averages and then be able to close above them as well. The summation index based on price starting to turn up a little bit. The McClellan oscillator is now above 0, and that's where this chart gets its data from. But we've been seeing for a few days now the turn up in volume of the summation index. Sometimes this is a leading indicator. New highs, new lows, starting to turn up and show some improvement, even though we've been going pretty much flat on the raw scores, and we're turning up slightly with the 10-day. So internally, we're seeing a little bit of improvement. But if we go down, because we're at the upper end of this trading range, if we go down, it'll pretty much wipe all of these positive signs out. Then we're still neutral with the elder impulse system, looking at the S&P 500. Short-term fib levels, we're still above this double fib retracement. If we do try to break out of this and go higher, we're at about and it's really hard for me to see these numbers. It's about 38, 81, 91. It's really hard for me to see those. This is one that I have not shown in a long time because I haven't really been able to. This is a Copic curve, and this is really good at showing us bottoms in the market. This is just about getting ready to cross over positive. And if you pause this and look, sometimes this, when it crossed above the moving average, this gave us some decent, if not really good, signals. Back in October, we crossed over, and then we were able to go up after that. Sometimes this can give us false signals as well. So we want to use other indicators to make our assessments. Another one that I haven't shown in a long time, this is a ratio of the staples sector, the things that you have to have, against the S&P 500. And when, again, you might want to pause and look at this, if I can get back to the right chart, where a lot of times when we spike up with this and it starts to go down, that marks some kind of a bottom in the S&P 500. But the thing is, we don't know if this is a spike. For those of you that have been watching the videos for a long time now, we spent most of 22 in this area just wondering, are we going to break out only to have it break down? Are we going to break out only to have it break down? So just because this is a spike and it's starting to go back lower does not necessarily mean, oh, buy. We have to wait a little while and use other charts to give us some confirmation. The mid caps are still just coming off of a recent golden cross. That could help give some support to the market. And then the Dow gave us a golden cross a while back now, and we're still above the 200-day moving average. Right now, the Dow is on its 50-period moving average. Our outlook then for Thursday, the technicals, they're still negative overall, but they're possibly improving. If we have a down day or two and we get back down into that trading range that we've been in, that's going to negate a lot of the positive things that we've been seeing. We have the ADP employment report coming out, and then weekly jobless claims, and then the trade balance, and then the final IHS market manufacturing services PMI. None of these in and of themselves are all that influential. The big report is going to come out on Friday when we get the employment situation report. And then the geopolitical events, the ones that the markets are really worried about now are the inflation and interest rates. And it's been that same scenario. I could just hit the record button and just say that in every video for the last year. Our scenario is really difficult to go with the down scenario now because we're not trending, and we might be improving with our technical picture. Can't go with the up scenario because we're not trending. Although the positive setup, that was the sector to S&P ratio that I was showing you. Our sector rotation, not doing very good right now. And our different scenarios, those charts are kind of midway. They're not really giving us anything significant currently because our technicals are still pretty much negative. We have moving averages above where the S&P is at right now, so they will probably provide some kind of resistance if we go up. So far, the pivots and the fib retracements, those are holding up, and they're providing some support. If we lose those, that could turn things back more negative. So we're going with the sideways, the trend for right now, because the ADX, it's below the moving average, so it's weakening. We're also below 20, and the red line is still on top, even though it's declining. So we default to negative. So our conclusion, the S&P is negative and in a range, but it might be improving. In the short term, we're negative and slightly oversold. Those couple of charts that I showed you are extreme negative. Intermediate term, we're just still negative for the most part, but we could be seeing some improvement there, but we have to break out of this range first. Long term, we're still negative because we're below the 200-day simple moving average. Thank you. Have a wonderful day on Thursday, and I will look to prepare the next video before Friday's session.